file TDS returns yet? Don't be late. File your quarterly salary TDS return today. The Income Tax Act mandates every employer to deduct TDS on salary payments in case the salary of the employee exceeds the basic exemption limit. Hello and welcome. I'm Anita from Clear. We have assisted more than 80,000 tax experts and 6 million tax filers. Do subscribe to us and get a clear explanation of finance concepts. Let's understand what TDS on salary is all about. As per Section 192 of the Income Tax Act 1961, TDS is deductible on salary income. Depending on the employee's net taxable salary, the employer deducts the tax on the employee's behalf and deposits it to the Income Tax Department. Such TDS deducted is reflected on Form 16 issued by the employer. The employee can calculate the income tax liability at the end of the financial year and then adjust the TDS to pay the differential liability or claim a tax refund. Now the question is, who can deduct TDS on salary under Section 192? The employer can deduct the TDS whether resident or non-resident, being a public or a private company, individual, trust, Hindu undivided family, cooperative society, partnership firm, association of persons or body of individuals, and local authority. There should be an employer-employee relationship between such entities and the taxpayer. The TDS on salary income can be estimated by following the below steps. The first step is to estimate gross income of the employee for the said financial year. This should include basic pay, DNS allowance per proceeds granted by the employer, other allowances granted by the employer like HRA, LTA, meal coupons, etc., then EPF contributions, bonus, commissions, gratuity, salary from the previous employer if any, etc. Now, calculate exemptions under Section 10 of the Income Tax Act. The exemptions can be applicable on allowances like HRA, travel expenses, uniform expenses, children education allowances, etc. Also, reduce the professional tax paid, entertainment allowance and standard deduction of Rs 50,000 from the salary. Reduce such exemptions from the gross monthly income calculated in Step 1. The net amount will be the taxable salary income. Suppose the employee has provided the information about other incomes such as rental income from house property or interest from bank deposits, etc. In that case, such amount should be added to the net taxable salary. Further, the interest paid on housing loans can be deducted from the house property income. But where there is no income from house property, there will be a negative figure under the head Income from House Property for the deduction taken for interest on home loan. After adding or reducing the said amounts, the calculated figure will be the employee's gross total income. In the next step, reduce the investments for the year which fall under Chapter 6A of the Income Tax Act declared by the employees as per the investment declaration submitted. Subtract this amount from the gross income calculated. Allow deductions for investments such as Public Provident Fund, Employees Provident Fund, ELSS, National Savings Certificate, Sukanya Samriddhi Account, etc. Also allow deductions for expenditures such as home loan repayment, life insurance premiums, etc. Similarly, allow deduction under Section 80G, 80G, etc. as declared by the employee. Please note that if the employee has declared to calculate income tax as per the new tax regime, then the Income Tax Act does not allow 70 exemptions and deductions allowed in the old tax regime. Hence, you should calculate the net taxable income as per the tax regime selected by the employee. Calculate income tax as per the applicable tax slab rates including cess at 4%. The tax amount calculated should be divided by 12 and this will be the monthly TDS amount to be deducted from the employee's salary. This is how TDS is calculated on salary. Is it now clear to you? If yes, please comment yes in the comment section below. The employee will be qualified to get the credit of the deducted income tax amount from their salary. While filing income tax return, the employee can take such credit based on Form 26A or TDS Certificate, that is Form 16 issued by the employer. Now let's know the time limit to deposit the TDS amount. TDS deducted from salary by the employer is required to be deposited to the government within the given timelines to avoid interest payment. TDS deducted for the month of April to February should be deposited by 7th of the subsequent month, and TDS deducted for March should be deposited by 30th of April. The employer has to file a salary TDS return in Form 24Q. The said form is to be submitted every quarter. Details of salary paid to the employees and TDS deducted on such payment is to be reported in Form 24Q. You can easily file your TDS returns through Clear Tax software, that is Clear TDS. Form 24Q consists of two annexures, Annexure 1 and Annexure 2. While Annexure 1 has to be submitted for all 4 quarters of a financial year, Annexure 2 is not required to be submitted for the first 3 quarters. Annexure 2 has to be submitted in the last quarter, that is January to March quarter only. The employer is responsible for providing a TDS certificate to the employee for tax deducted from the salary. After filing the TDS return, the TDS certificate, that is Form 16, generated in a specified format, can be downloaded from Traces utility. Form 16 contains Part A and Part B. Part A of Form 16 mainly contains the details of quarterly TDS deducted and deposited and details of PAN and TAN of the employer and other information. Part B of Form 16 is an annexure to Part A. Part B contains salary breakup, exemptions, deductions approved under Chapter 6A and the income tax amount. There may be a situation where there is more than one employer in one particular financial year. If the employee resigns and joins another employer during the financial year, then the details of his previous employment are required to be given in Form 12B to his new employer to deduct TDS properly. Accordingly, the next employer will consider his previous salary and TDS should be deducted while calculating TDS for the remaining months of the financial year. The employer is not responsible for deducting TDS on tips paid to the waiter by the customer directly or to the employer, since the tip does not become part of the salary income. Another important point to note is TDS under Section 192 should not be deducted for payment made to doctors by the hospital, since it is considered a professional fees. But if it is a contract of service, then TDS under Section 192 shall be deducted. The last but not the least, remuneration paid to directors by the company is not covered under Section 192. It is covered under Section 194J as a professional fee. I hope it will now be easier for you to calculate TDS on salary. For queries related to business or finance, you can contact our experts by clicking on the chat link provided in the description box below. Also, don't forget to subscribe to our channel for more informative videos and stay tuned for more updates. Thank you.